Right now, today, February 27th, 2026, is one of the most important days in the history of the silver market. Not because of a news headline, not because of a Federal Reserve announcement, but because of a single date on a calendar that almost nobody outside of institutional trading desks even knows about. Today is first notice day for the COMEX March silver futures contract, and what that means, in plain English, is that as of this morning, the clock has officially started on a delivery obligation that is, mathematically, impossible to fulfill. Let me give you the numbers, because numbers don't lie. The March 2026 silver contract carries 528 million ounces of paper exposure. 528 million ounces. The total registered silver sitting in COMEX vaults right now, the silver that is actually available for delivery, is somewhere between 88 and 113 million ounces. That means there are more than 4 paper claims for every single physical ounce of silver on this exchange. 4 claims, 1 bar. And today is the day the music stops. Now here's what makes this story truly unbelievable. This didn't just happen overnight. 2 players, one an American banking giant that was literally convicted of manipulating this very market, and the other a coalition of nations actively trying to dismantle dollar dominance, have been quietly, systematically, and brilliantly setting this up for years. JPMorgan and BRICS. And what they are doing to COMEX right now will fundamentally change how silver is priced, traded, and owned for the next generation. Stay with me, because this is the most important financial story almost nobody is talking about. Let's start with JPMorgan, because their story is one of the most stunning reversals in modern financial history, and it tells you everything you need to know about where this market is headed. For nearly 2 decades, JPMorgan was the largest silver short seller on COMEX. Short selling means betting that prices will go down, and for years, they were very, very good at it. In fact, the Commodity Futures Trading Commission, the government regulator that oversees these markets, eventually investigated JPMorgan and found that from at least 2008 through 2016, the bank placed hundreds of thousands of fake sell orders in precious metals futures. These are called spoof orders. You put in a giant sell order to scare other traders into thinking prices are collapsing. Other traders panic and sell. Prices drop, and then you quietly cancel your fake order and buy at the bottom. Rinse and repeat for 8 years straight. The CFTC ordered JPMorgan to pay $920.2 million, the largest monetary relief the CFTC has ever imposed, for manipulative conduct that, in their own words, significantly benefited JPMorgan and harmed other market participants. So JPMorgan manipulated silver prices downward for nearly a decade. That part is not a conspiracy theory. It is a federal legal ruling with a $920 million price tag attached to it. Now here is the critical question. What did they do while prices were suppressed? They bought. They bought physical silver hand over fist, quietly, steadily, for years. When silver was stuck between $14 and $20 an ounce, artificially, JPMorgan was accumulating. Estimates now put their total physical silver stockpile at over 750 million ounces. The largest private silver hoard since the Hunt brothers tried to corner this market in 1980. And then, in early 2026, something remarkable happened. The first CME Group delivery report of the year showed a complete and total strategic reversal. JPMorgan flipped from short and suppress to aggressively standing for maximum physical delivery. On January 7th alone, JPMorgan issued delivery notices for 99% of 8.1 million ounces, through 1,624 contracts, in a single day. They are no longer betting that silver goes down. They have the metal. They are demanding real bars. And at $87 an ounce, where silver is trading right now, their $14 cost basis has turned into one of the greatest commodity trades in Wall Street history. They suppressed it, they hoarded it, and now they are riding it all the way up. The only question left is, how high does it go? Now let's zoom out and look at what is happening to COMEX itself, because the institution that has been the global pricing mechanism for silver for decades is cracking apart in real time. To understand this, you need to understand one key concept: the difference between registered silver and eligible silver. Registered silver is metal that is vaulted, verified, and immediately available for delivery against a futures contract. It is the only silver that actually matters when delivery demands come in. Eligible silver is metal stored in COMEX-approved warehouses that meets exchange specifications, but it is not available for delivery unless the owner specifically decides to convert it. Think of registered as cash in your checking account, and eligible as a long-term CD you can't easily touch. In 2020, COMEX had 346 million ounces of registered silver. Today, in February 2026, that number has collapsed to somewhere between 88 and 113 million ounces, a 75% drain over 5 years. And the drain is accelerating. In just the first week of January 2026, COMEX warehouses experienced a 33.45 million ounce withdrawal in 7 days. That is 26% of registered inventory vanishing in a single week. On February 11th, a single-day negative adjustment of 3.25 million ounces pushed total registered silver below 100 million ounces for the first time in years, hitting 98.1 million. On the same day, 4.7 million ounces were withdrawn from the eligible category in 24 hours. And the delivery pressure is not letting up. February deliveries already reached 2,700 contracts, representing 13.8 million ounces, with no sign of slowing. Meanwhile, open interest in the March contract sits between 85,000 and 91,000 contracts, representing a theoretical delivery obligation of 425 to 455 million ounces, against 88 to 113 million ounces of available metal. Even if only 20% of those contracts demand physical delivery, a historically conservative estimate, COMEX does not have the silver to cover it. Veteran analysts are not mincing words. One widely cited analyst put it this way: all it would take is for 20% of March contracts to stand for delivery, and the vault is drained. And given what we have seen in January and February, 20% would seem extremely low. The probability points far higher. The COMEX math has officially failed. 5 paper claims for every 1 physical bar. And first notice day was this morning. Now let's talk about the other player in this story. And honestly, their move may be even more consequential than anything JPMorgan has done. On January 1st, 2026, Beijing didn't just change a regulation. They fired a shot across the bow of the entire Western financial system. China controls between 60 and 70% of the world's refined silver supply. It is the world's dominant gatekeeper for mined silver globally. And on January 1st, the Chinese government reclassified silver from an ordinary commodity to a strategic resource subject to strict government licensing. Under the new framework, only 44 state-approved companies received authorization to export silver during the 2026 to 2027 period. And to even qualify, an exporting firm must produce at least 80 tons of silver annually and maintain $30 million in credit lines, requirements that effectively exclude hundreds of smaller and mid-sized exporters who have historically supplied global industrial markets. This mirrors precisely what China did with rare earth metals, first cornering the market through production dominance, then weaponizing export controls to establish geopolitical leverage. And it is working. The purpose is dual: protect China's own industrial supply for domestic solar, EV, and electronics manufacturing, while simultaneously creating leverage over Western monetary and trade policy. As one analyst from FX Street described it, China is treating silver the same way OPEC treats oil, and the West is just now realizing it. The immediate impact was staggering. On January 1st, 2026, while COMEX silver futures showed $72 per ounce, physical bullion dealers in Japan and the UAE were selling, when they could find inventory at all, at $130 per ounce, an 80% premium for physical silver over the official paper price. This has never happened in modern precious metals markets. Gold might see a 5 to 10% premium during supply crunches. An 80% sustained decoupling across an entire region is not a blip. It is a signal that the paper price has become fiction. India placed a $76 billion order for precious metals directly through the Shanghai Gold Exchange, completely bypassing COMEX in London entirely. Silver lease rates in London spiked from 0.25% to 200% overnight, following a single 1,000-ton Indian order in October 2025, causing Swiss refiner Metalor to temporarily shut down operations. And BRICS nations are now coordinating resource policies. Russia's palladium and platinum, Brazil's niobium, South Africa's platinum group metals, all potentially aligned in a broader resource sovereignty framework designed to reduce dollar dependency and pressure Western financial systems where they are most vulnerable: in commodities. To truly understand what is happening, you need to understand the fundamental fraud at the heart of the modern silver market. Because once you see it, you cannot unsee it. COMEX is run by CME Group, a for-profit corporation listed on the NASDAQ. Its clearing members, the entities that backstop the exchange, are the very same bullion banks that hold massive short positions in silver: JPMorgan, Goldman Sachs. The banks that lose money when silver prices rise are the same institutions that set the rules of the exchange. Under CME Rule 802 in Chapter 7, the CME Board has the absolute right to change margin requirements at any time, without notice, for any reason. This is not a neutral referee. This is the losing team writing the rules of the game, and they exercise that power aggressively. On January 7, 2026, as silver was surging and short positions were getting destroyed, the CME raised silver maintenance margins to $32,500, a 47% increase in a single week. The result? Leveraged traders who were winning got margin called out of their positions. In Rajkot, India alone, 44 silver trading firms officially declared insolvency, with liabilities approaching $425 million. These traders were not wrong about the direction of silver. They were right. But the casino changed the rules mid-game, and they were wiped out in hours. At the notional level, the fraud runs even deeper. For decades, global silver price discovery has been dominated by futures traders on COMEX and the LBMA in London, and at times, the ratio of paper ounces traded to physical ounces in existence has reached as high as 356 to 1. The entire system operates on one sacred assumption, that the vast majority of futures contract holders will never actually demand physical delivery. They will roll their contracts, they will take cash, they will play the paper game. In early 2026, that assumption collapsed. Traders around the world, from institutional funds to sovereign wealth managers, began standing for physical delivery in numbers that the exchange cannot mathematically accommodate. The casino is being called on its bluff. So where does this go from here? Analysts are converging around three distinct scenarios, and each one has dramatically different implications for the silver price. Scenario 1, the shadow bailout. This is considered the most likely near-term outcome. JPMorgan raids the 91 million ounces currently sitting in the SLV ETF New York vault. Acting as an authorized participant, they can legally extract physical silver baskets from the ETF in exchange for destroying paper shares. They then attach COMEX warrants to those bars and shift them from eligible into registered inventory, artificially restocking the exchange. Simultaneously, they use exchange for physical, EFP, deals to pay massive cash premiums to large contract holders to convince them to surrender their delivery demands and roll to London. The hole gets plugged with ETF silver and cash. The system survives, barely, but the structural deficit remains. Silver prices retreat temporarily, perhaps to the $65 to $75 range before the next squeeze. This buys the banks 6 months, maybe a year. Scenario 2. Delivery delay and position close only. If physical demand is more aggressive than the shadow bailout can absorb, the CME steps in with emergency measures. They declare a delivery delay, or, as they did with silver in the 1980 Hunt Brothers crisis, change the rules to position close only, banning new long positions and forcing the market to liquidate. This is what analysts call the nuclear option for short sellers. Silver prices crash violently in the short term. We could see $50 to $60, but the underlying physical shortage remains completely unresolved. The paper price becomes purely notional. Physical premiums in Asia explode even further. And the long-term structural bull case for silver actually strengthens because the fraud is now fully exposed to the world. Scenario 3. Historic reckoning. This is the scenario the mainstream financial media refuses to discuss, but it is not zero probability. Physical demand overwhelms all available mechanisms. COMEX is forced to declare force majeure or cash settlement on the March contract. The event triggers a cascade. Institutional holders of silver ETFs convert to physical. Miners begin bypassing COMEX and dealing directly with industrial buyers, and sovereign wealth funds in Asia accelerate their de-dollarization by pricing silver trades through Shanghai. The gold-silver ratio, currently near 50 to 1, compresses toward its historical extremes of 15 to 20 to 1. If gold maintains $3,000 to $4,000 per ounce and the ratio compresses to 20 to 1, that implies silver at $150 to $200. If solid-state battery adoption drives automotive silver demand, and Stanford research published in January 2026 showed a nanoscale silver coating can solve the cracking problem in solid-state batteries, potentially increasing per-vehicle silver consumption from 50 grams to 1 kilogram, the demand side of this equation explodes in ways current price models cannot capture. Here is the bottom line. JPMorgan spent years suppressing silver prices and was convicted and fined nearly $1 billion for doing it. During that suppression, they quietly accumulated an estimated 750 million ounces of physical silver. They have now flipped entirely to the long side and are demanding physical delivery from the very exchange they once manipulated. BRICS nations, led by China, have weaponized silver supply by restricting exports that represent 60 to 70% of global refined silver. COMEX vaults have lost 75% of their registered inventory since 2020. The March contract carries 4 times more paper exposure than there is physical silver to back it. And today, February 27, 2026, was First Notice Day. This is not a story about silver going up or down next week. This is a story about the end of a 50-year experiment in paper-based commodity pricing, and the beginning of a new era where physical possession, industrial demand, and geopolitical control determine what this metal is actually worth. The banks are not your enemy in this story. They played the game better than anyone. The question is whether you understand the game well enough to position yourself before the rest of the world figures out what is already happening. If you found this valuable, please hit like. It genuinely helps this content reach more people. Subscribe for daily silver market updates, and drop a comment below. Do you think COMEX will default on the March contract, or will JPMorgan find a way to plug the hole one more time? I read every single comment. I will see you in the next one.